What is going on, guys? Welcome back to the channel. I hope you're all doing good and having an amazing day. So in today's video, we're going to be taking a look at the difference between investing for dividends and income compared to investing in growth stocks and accumulation funds. Now, there are so many different ways in which you can choose to invest in the stock market, but these are the two most popular and common long-term investment options. So in this video, I'm going to be going through the basics as to what they both are, how they work, along with what the main differences are and who they might be targeted at. And finally, at the end, I'll give my personal opinion as to what I prefer to invest in myself. Now, just before we jump straight into it, I know it is a bit cheeky asking before the video's even started, but I'd really appreciate it if you guys could smash that like button down below, as it does really help me out with the YouTube algorithm and just allows YouTube to share these videos to more people that might find them useful or interesting. And if you are new around here, make sure to hit that subscribe button down below and click that bell so you never miss a video. And just quickly, as a disclaimer, this is in no way financial advice. I'm simply just outlining information and giving my honest opinions and thoughts. Always make sure to do your own research when it comes to your finances. But with all of that out of the way, let's get into it. Okay, so the first thing to cover are the basics and what do these terms mean, dividends and income, as opposed to accumulation and investing for growth. Let's start with growth stocks to begin with. So most people typically, when they think about investing in the stock market, think about the idea of buying shares in a company or a fund at one price, then selling them on at a later date at a higher price to then turn a profit. And you're able to generate profit from that increase in share price. And this is essentially what investing for growth is. So the main focus when choosing what investments to go for, whether it's a fund or an individual company, you'll be typically looking for a share price chart with an uptrending pattern, anticipating that that share price will keep increasing in value. But the main thing to remember is that the profits can only be made and cashed in once you actually sell that investment. So this sort of investing might be appropriate for you if you want to just put some money aside, leave it for a long period of time and wait for it to grow. And you aren't worried about seeing any returns that you can actually use and spend. So quite often you'll see people focusing on growth investing where maybe they're in an earlier stage of their investment journey trying to build overall wealth, compounding as much of the profits as possible to increase that overall portfolio size. Okay, so now we have the other strategy, which is investing for income in the form of dividends. So you might be thinking, what are dividends? So essentially it's when a company or fund shares out a portion of its earnings to its shareholders in the form of cash. So these tend to be paid out quarterly, semi-annually, or even annually. But this will vary depending on which investment you're in. So the advantage of dividend paying investments is that you can actually see some physical return on that money that you can actually go out and use. So this might be particularly appealing if you're looking to create a supplementary income for yourself, or if you have a particularly large sum of money to invest and aren't necessarily worried about seeing the profits compounded. And quite often you'll see people shift their focus to income investing when maybe they're approaching retirement age and are looking to receive some income from their money once they retire. So the main thing to focus on when looking for an income investment is a high percentage dividend yield, rather than looking at the overall increase in share price. And quite often the share price with income investments can be quite stagnant over time. Okay, so hopefully that clears up what the basics are and what these terms mean. But the important thing to remember is that a lot of investments actually focus on both the increase in share price value as well as paying out dividends. So it's almost always essential to look at both aspects when looking for an investment opportunity. So with all that in mind, you might now be thinking, what are the returns like from one compared to the other? Well, honestly, it's not really that straightforward, and you can find both low and high risk options in each category, depending on what you're looking for. Typically though, if you're looking for really high percentage returns on your money, you're going to be wanting to look at growth stocks. So they can be extremely volatile with fluctuating share prices, but this creates the opportunity to make money from that share price increase in value. Income-focused investments are generally a bit slower though, and it's unlikely to see as extreme returns. With that being said though, with certain investment opportunities, you can actually achieve identical returns. It just depends on your preference as to which form you'd rather see those profits. So whether it's as an income or an increase in share price. So with certain investment funds, they might have multiple packages, one designed for income and one designed for accumulation. And so the returns over a year might work out to be the same, but with the accumulation funds, often the dividends are reinvested, pushing the share price up, rather than being paid out to you as the investor. So over time, those profits are automatically reinvested and compounded without you having to worry about reinvesting. Now, it's impossible to give a completely accurate figure as to what returns you might expect to make from each type of investment. But a consistent dividend-focused investment might pay out between 2 and 10% per year. But with some growth-focused stocks, you might see returns some years ranging from 10% to 100%. It really isn't an exact science though, and it's essential to look at both factors when picking an investment, because you may find an investment that's paying out really high dividends, but actually it's decreasing in value every single year that you're holding that investment. So it could be up 5% from dividends, but down 7% on the year in share price value. which would leave you at a 2% loss overall. So it's essential that you make sure not to look at just one of these factors in isolation and always consider both elements. So with all that being said, let's now look at some examples to give you guys a really good idea of what it actually looks like in reality. So I'm here on TrustNet, which is a great website that I use to scan for different investment opportunities and most specifically funds. So personally, I invest predominantly in investment trusts, so we'll stick to those for now. So now we can see all the investment trusts that are listed on TrustNet. And what you can do is break it down by top performers based on yield, which means dividend that they pay out each year. So at the top you can see this one has a huge dividend yield of 18%, which means it paid out 18% in dividends last year. But actually over that year the share price has decreased by 3%, and over the last 3 years it's decreased by 4.3%. So if you're invested in this, although you're making return in terms of dividends, the actual overall investment value will be slowly decreasing over that time period. So if you look at the chart performance for this particular one, you can see it's been pretty stagnant in terms of share price over the last 5 years, and actually it's taken a really big dip recently, which isn't good. But actually if we look on Hargreaves Lansdown, we can see the previous year's dividend return. So although the share price hasn't done an awful lot over that 5-year period, it has paid out some really significant dividends. And so coming back onto TrustNet, this is usually a similar story for most of the funds listed on here. So to distinguish those that are income focused, they basically have a high yield, but usually at the sacrifice of a pretty stagnant share price. So you can see a lot of the higher income paying ones are actually negative over a longer period of time in terms of share price value. So you have to consider both elements when picking stocks to invest in. And then typically as we move down the list, as the dividend yield gets lower, the actual share price return over the years gets more appealing. So you can see the one with the highest paying dividend over 5 years only is up 8.5% in terms of share price value. But once we come down to some of the ones with around a 4% dividend yield, you can see the increase in share price value over 5 years is up to 85%. And so now I'm just going to switch the column priority to 5-year return. So you can see now at the top we have the Scottish Mortgage Investment Trust PLC, which over 5 years has made a return of 354%. But in terms of dividend yield, it only pays out 0.26%, which is pretty insignificant really. But it just shows that the focus of this particular investment is to make money through share price increase rather than receiving income. And so actually in the last year, the share price value has increased by 52%, which is actually a lot higher in terms of overall annual return compared to the highest paying dividend funds. And again, as we move down the list, you can see most of the investment trusts that make really high annual returns don't actually pay much dividends at all. But obviously there are some anomalies like the JP Morgan China Growth and Income Fund, which is designed to pay out both income and achieve growth. Okay, so now we've had a quick look at some real world examples of some dividend focused funds and some growth focused funds. The question is, which is better? Well, really it comes down to personal preference and what your investment goals are. So if you're looking for a more consistent return or maybe a supplementary income, dividend focused investing is probably the way to go. It's important to remember though that the dividend rates that they pay out can actually vary from year to year, and it's not always consistent. However, most income focused investments don't pay out a huge amount in terms of percent. So more often than not, you'll need a large amount of money invested to actually make that dividend income feel significant. So for example, if you had £1 million invested into a 5% yielding dividend stock, then that might be a perfect scenario for you if you're about to retire and you've built up this amount of wealth over the years and want to start generating some income from that money. Because that £1 million invested will give you £50,000 in income each year, assuming that dividend remains consistent. On the other hand though, if you are just starting out on your investment journey and you have £1,000 to invest, I would say growth focused stocks are probably the way to go rather than income focused investments. I feel if you're in this particular situation, you actually have a lot less to lose, so you can afford to go for more risky investments. And if your overall investment goal is to become financially independent, you're really going to have to be chasing higher returns and making sure that you compound all the profits that you make. Because otherwise, if you take out profits and invest more conservatively, you're simply just not going to be able to build wealth in the same way. So for example, if you started out with that £1,000 and invested in something that gave you a consistent return of 10% per year, but if you took out those profits as dividends and didn't reinvest, it would take you 10 years to double your money. Whereas with the same amount of money, if you simply just reinvest it, it'll only take you 7 years to double your money initially. So to me, it just seems like a logical option if your focus is to grow your investment portfolio. It makes more sense to stick with accumulation and growth stocks, as it makes it a lot easier to compound your profits. But if you already have a massive wealth and you're looking to get some income from that money, then yes, dividend investing seems like a solid option. So with all of that considered, you guys now might be wondering, what do I personally do? Well, my overall investment portfolio value isn't at a large enough size where I see there being much point in investing for income. The return that I would get I don't think would be particularly significant, and it doesn't really align with my overall goals. At this point, my investment portfolio is in the growth phase, and I'm looking to just grow my account value as much as possible without taking any money out at all. So I'm looking at some potentially more risky opportunities that have high potential for growth, and also accumulation funds, as it makes it a lot easier to compound all the profits, as you essentially just leave the money invested and let it do its thing, rather than having to worry about reinvesting dividends. But with that being said, if all goes to plan and I can continue to keep building my investment portfolio, I can see my strategy changing to start incorporating some more income-focused investments. But there we have it. That basically covers everything for today, guys. I really hope you guys did enjoy this one, and I'd be really interested to know what you guys personally do. Do you focus more on investing for dividends and income, or are you more into trying to grow your account as much as possible, looking at accumulation funds and high growth stocks? I'd love to hear, so let me know down below in the comments. And as always, if you do have any feedback or questions for me, I make sure to respond to all comments, so just drop your thoughts down below as well. If you did make it this far, thank you so much for watching, and if you did enjoy the video or feel like you learned something new in any way, I'd really appreciate it if you guys could smash that like button down below, as it does really help me out with the YouTube algorithm and just allows YouTube to share these videos to more people that might find them useful or interesting. And as always, if you are new around here, make sure to hit that subscribe button down below and click that bell so that you never miss a video. But with all that being said, take it easy guys and keep saving.